Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. That is going to be a special session as many of the students requested in the comment section to take the MCQ session on the Financial Stability Report of June 2025. So I have brought this special session for all of you. So today we will discuss the most important MCQs for the Financial Stability Report June 2025. Okay, and in this session I will mark the important data so that this data you should not be missing out at all. Okay, so this is going to be very important session for all of you who are preparing for the RBI examination. So we are going to discuss the most important MCQs. Let's see how much of the data you remember from the Financial Stability Report of June 2025, which is a very important report from the examination point of view. And today I will mark the data, so that data will be the most important data, and I will tell you that how you have to remember the important key points. Okay, so let's start with today's session. I hope you all are excited for today's session. Many of the requests were coming to take the MCQ session for the Financial Stability Report. So here it is for you. Okay, so let's start with it. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so give me a thumbs up sign if everything is fine, if I'm clearly audible and visible, and if you are excited for the session and if you are excited for the MCQs, give me a thumbs up. Okay, and I have tried to prepare the MCQs from the overall report, from the overall all the areas, so you will get the gist that what kind of data points are important from the examination point of view. Okay, so before moving to the first question, give me a thumbs up if everything is audible, visible, everything is fine. Okay, so here in front of you is the first, before going to the first question, remember that I have taken a complete session on Financial Stability Report for June 2025 where we have done the detailed coverage of the 3 chapters that is present in the Financial Stability Report, and we have also discussed the survey, systemic risk survey that was given in the Financial Stability Report. So we have discussed the Financial Stability Report in depth. So in today's session we are only going to practice the MCQs. I am only going to tell you that which data points are important. We are not going to discuss the points in detail. Okay, we are not going to go too much in depth because we have already done the detailed coverage. So let's make this session short and sweet. Okay, so let's start with the first question now. This is the first question in front of you, which is asking you about the global economy. So read the question very carefully, read the statements very carefully, and try to answer the question. Okay. So the first question is in front of you, that is, as per FSR, the Financial Stability Report June 2025, the global macroeconomic outlook has deteriorated amid the headwinds from the persistent trade frictions that is happening between the country, the heightened policy uncertainties there, weak consumer sentiment is there. Despite some easing in the tariff tension, still there is persistent problems that are coming up. Okay, so now which of the following statement is or are correct in regards to the global economy, that you have to tell me. Okay, so the first statement is regarding the International Monetary Fund. In its April 2025 World Economic Outlook has revised the global growth projections downwards to 2.8% in 2025 from 3.3% in 2024. Is it correct? Yes, it is absolutely correct. The next is that the OECD in its economic outlook released in June 2025 has revised the global GDP growth forecast for 2025 to 2.9%. This is also correct, that yes, OECD has also revised its global GDP growth forecast to 2.9%. The third statement is that the global public debt as a percentage of GDP is projected to reach above 95% this year. That is correct, but it is going to be 100% by the end of the decade. So by the end of by 2030, by the end of the decade means by 2030, it is expected that the GDP, the debt to GDP ratio, or the global public debt as a percentage of GDP, it is going to be 100% by 2030. In the severe stress scenario or in the severe adverse situation, then it will be 117% by 2027, not by 2030. Okay, so this statement was wrong. The third statement is wrong. So the answer here is 1 and 2. So the correct statements are 1 and 2. Okay, so here you can see that the important data points have been marked here. This is the data for the US in regards to the tariff that the US is imposing. So the US has imposed very high tariff, due to which as compared to 2024, the tariff has increased immensely. Okay, next is the growth forecast has been given. The GDP, real GDP projections have been given by IMF, OECD and the World Bank. This you have to remember. So the IMF has said that the GDP growth will go from 3.3% to 2.8%, and in 2026 it is going to increase to 3% from 2.8%. Okay, World Bank has said that the GDP growth will be 2.9% in 2025. This is the same projection that is given by OECD. Now coming to the global public debt as a percentage of GDP, it is projected to reach above 95% this year and 100% by the end of decade, that is by 2030. It is going to reach above 100% or at 100%, while it may reach 117% by 2027 in a severely adverse scenario. Okay, so this is the data point that you have to focus on here. Now coming to the next question, this is regarding your domestic economy. So in regards to domestic economy, which of the following statements is incorrect, that you have to tell. So read the statements carefully and try to answer this question. So here, the Indian economy supported by strong macroeconomic fundamentals. Which of the following statement is incorrect in regards to the domestic economy? So I am starting to get the answers. So C, Guru Raja is saying C. Okay, let's see. So domestic inflation has been steadily declining, that is correct, with the headline consumer price index inflation, that is the headline inflation or the retail inflation, has recorded a 6-year low of 2.8% of the CPI inflation in May 2025. Absolutely correct. The current account deficit is at 0.6% of the GDP during 2024-25. Correct. It is estimated that a 100 basis point slowdown, that is a 1% slowdown in the global growth, can affect or pull down India's growth by 50 basis point. No, it is by how much basis point? It is by 30 basis points. So that means a 100 basis point slowdown in the global growth will pull down the growth of India by 30 basis point, that is by 0.3%. Okay, so 1% slowdown in global growth will lead India's growth to be pulled down to by 0.3%. Okay, by 0.3%. So India's public debt to GDP was 81.3% in 2024. Correct. Resource mobilization through capital market grew by 32.9% in 2024-25. Debt markets had been the dominant source through which resource mobilization has happened. So this is also correct, of which 99.2% was raised through the listed private placements. So absolutely correct. So only the C statement was wrong, and that's why the C is the right answer. Okay, so here the important data has been marked. Here you can see that the inflation has reached the 6-year low of 2.8% in May 2025. 100 basis points slowdown in global growth can, ceteris paribus, pull down India's growth by 30 basis points. Ceteris paribus means that other things remaining constant, other things remaining same. If the global growth is slowing down by 100 basis point, the India's growth is going to slow down by 30 basis point. Now the debt to GDP ratio, this is the data for 2024. This is the India's fiscal position comparison in 2024. So debt to GDP ratio or the debt to GDP percentage was 81.3%. Primary deficit, so primary balance is in negative. That means there is a primary deficit in India of 2.3%. Now interest to the revenue, the interest as a part of the revenue of the government was 24.3%. That means out of the revenue of the government is paying 24.3% in the interest as the interest. Current account deficit was at 0.6% of the GDP during 2024-25, and the resource mobilization through capital markets have grown by 32.9%. I am repeating the data so that you are able to recall it again and again. So repeat it with me. So resource mobilization through capital market grew by 32.9%. Dominant share was of debt markets, that was 63.5%, out of which 99.2% was raised through the listed private placement. Equity market accounted for 27.4% of the resource mobilization. Okay, so this is the important data that you have to focus on. Coming to the next slide, coming to the next question, this is regarding the scheduled commercial bank. So all the data regarding the scheduled commercial bank is going to be important from your financial stability report June 2025. So try to answer this question. Okay, so which of the following statement is or are incorrect in regard to the financial stability report June 2025? So scheduled commercial bank aggregate deposits grew by 10.7% year on year during 2024-25, notwithstanding. So despite of a deceleration, that means the growth happened, but the growth happened by a lesser rate in respect to the private sector banks and foreign banks. So first statement is absolutely correct. The scheduled commercial bank continued to record improvement in their asset quality, and the gross non-performing asset decreased to a decadal low of 2.3%, multi-decadal low of 2.3%, and the NNPA, that is net non-performing asset, reduced to a multi-decadal low of 0.5%. Absolutely correct. As of March 2025, the capital to risk weighted asset ratio of the scheduled commercial bank increased to a record high of 17.3%. 17.3%. The profitability of scheduled commercial bank remained strong, and the profit after tax increased by 16.9% year on year. The return on asset of the scheduled commercial bank increased from 1.3% to 1.4% from March 2024 to March 2025. This is also absolutely correct. So all the data points are correct. Just here C was not correct, and that's why your answer is C here. Okay. Yes, very good. So everyone has given the right answer. Good to see that. So C is the right answer here. So here let me mark you the important data points. So deposit growth is by 10.7%. Then here gross non-performing asset ratio 2.3%, net non-performing asset ratio 0.5%, provisioning coverage ratio 76.3%. Okay, so deposit growth has grown by 10.7%. The gross non-performing asset has reduced to 2.3%. The net non-performing asset has reduced to 0.5%. Provisioning coverage ratio is 76.3%. The credit growth is by 11%. The return on equity is 13.6%. Return on asset is 1.4%. And net interest margin is 3.5%. Now, what is the meaning of net interest margin, provisioning coverage ratio? So all of this has been explained in the complete session that I have taken on the financial stability report. So let's not go too much in depth. Let's focus on the data here. So here you can see that the gross non-performing asset 2.3%, net non-performing asset 0.5%. The return on asset has increased from 1.3% to 1.4%, and the CRAR is 17.3%. The capital to risk weighted asset ratio is 17.3%, and the common equity tier 1 capital ratio is 14.7%. So out of the total capital to risk weighted asset ratio of 17.3%, there is the common equity tier 1 ratio of 14.7%. Okay. Next is your provisioning coverage ratio that covers the gross non-performing asset. So that is 76.3%, and your slippage as a percentage, or like as an annual percentage, is 1.4%. As a half yearly percent, it will be 0.7%. Okay. The profit after tax is profit after tax has increased by 16.9%. So all of these are the important data. Now coming to the next question, that macro stress test has happened for the scheduled commercial bank, and in the macro stress test there was the timeline that was taken that in March 2027, that by March 2027 in the baseline situation, what will be the condition? In the adverse scenario 1, what will be the condition for the CRAR? In the adverse scenario 2 condition, what will be the situation of the CRAR? Okay, so basically the macro stress test have happened of the scheduled commercial bank, and it has been seen that in the baseline, in the normal situation, what will be the CRAR in the scheduled commercial bank, what will be the CRAR during the adverse scenario 1, and what will be the CRAR in the adverse scenario 2 by March 2027. And here 46 major scheduled commercial bank have been taken for this kind of test. Okay, so here what is the correct answer? So the results revealed that the aggregate CRA of 46 major scheduled commercial bank may marginally dip to what percentage by March 2027 from 17.2% in March 2025 under the baseline scenario. It may decline to 14.2% in the adverse scenario 1, and it might decline to dash percentage under adverse scenario 2. So what is the answer here? Okay, so I'm getting the answer D here. Absolutely correct. Very good. So in the baseline scenario by March 2027, the CRAR will be 17.0%. It will be 17.0%. In the adverse scenario 1, it will be 14.2%. And in the adverse scenario 2, it will be 14.6%. Okay. So this is the data point. So here you can see that in the baseline scenario, the CRAR for the scheduled commercial bank for the 46 scheduled commercial bank will be 17%. So in the adverse scenario 1, it will be 14.2%. In the adverse scenario 2, it will be 14.6%. For the CET1 also, the data point has been given in the baseline scenario, adverse scenario 1, adverse scenario 2. For the GNPA also, the data point has been given for baseline scenario, adverse scenario 1, adverse scenario 2. The most important data here is of the CRAR, okay? Now coming to the next question, direct question can come in phase 1. In phase 2, the capital position of the urban cooperative banks continued to strengthen in the post-pandemic period with their CRAR rising to what percentage in March 2025? Try to answer this. So here, the CRAR, the capital position of the urban cooperative banks continued to strengthen in the post-pandemic period with their CRAR rising to 18%. Okay, so their CRAR has, yes, very good. Everyone is giving the right answer. Good to see that you have remember some of the data points. So that is good to see. So here you can see for the urban cooperative banks, the data point is that the credit growth is by 7.4%. The CRAR, that is the most important data for the primary urban cooperative banks, that has grown by 18%. The gross non-performing asset ratio has come down to 6.1%. The net non-performing asset ratio has come down to 0.6%. The provisioning coverage ratio is very, very high in the case of urban cooperative banks, that is 91%. So that means they have the provisions against the gross non-performing asset of 91%, okay, to cover the gross non-performing asset. Next is net interest margin, that is 3.6%. The return on asset is 0.7%. The return on equity is 6.6%, and the gross non-performing asset ratio of large borrowers in the case of urban cooperative banks is 8.9%. Okay, so that has also come down from the previous year. Now coming to the next question, this is in regards to the NBFCs. So as per the Financial Stability Report June 2025, which of the following statement is or are incorrect in regards to the NBFCs? So first of all, the system level credit to the capital to risk weighted asset ratio of NBFCs was healthy. So the system level capital to risk weighted asset ratio of NBFCs was healthy at 27.8%. What is the actual percentage, if anyone can tell me? The credit growth of NBFCs upper layer and middle layer rose to 20.7% in March 2025 from 16.0% in September 2024. NBFCs continue to record improvement in their asset quality with the GNPA ratio declining to what percentage here? It is not 2.0%. So the CRAR of the NBFCs, the CRAR of NBFCs is how much? Is it really 27.8%? I hope you remember. It is not 27.8%. It is 25.8%. Okay. So it is, the CRAR is 25.8% for the NBFCs. Okay. The credit growth of NBFCs, this is correct. The NBFCs continue to record improvement in their asset quality and the GNPA ratio has declined to 3%. Okay. So that means the first and third statements were incorrect, and that's why the answer is C here. The first statement is incorrect because the CRAR is not 27.8% for the NBFCs, it is 25.8%, as well as the GNPA ratio has declined to 3%. Okay. So I hope you will remember this now. So first and third statements were wrong, and that's why the answer is C here. So now here the important data points is that the credit growth in that the NBFCs have faced is 20.7%. The CRAR of the NBFCs is 25.8%. Okay. The return on equity is 10.6%. The return on asset for the NBFCs is 2.4%, and the net interest margin is 5.2%. Here most important data is of the CRAR, the credit growth, as well as the gross non-performing asset has reduced to 3%. The provisioning coverage ratio has come to 66.2%, and the gross, so sectoral data is not very important. Now coming to the next point, that is coming to the coming to this, try to answer this question. Okay. So try to answer the question regarding the IRDI, that is Insurance Regulatory Development Authority of India. So here, as of December 2024, the previous 3 quarters, the aggregate solvency ratio for the insurance companies remained above the prescribed threshold. So the Insurance Regulatory and Development Authority of India, that is IRDI, has notified the solvency ratio to be 150%. That means against the liabilities of the insurance companies, they have to maintain the assets of 150%. This is the minimum that they have to maintain. Okay. So it is, yes, the answer is C here. So very easy direct question that you can easily answer. The important percentages in this case is for the life insurance company. For the life insurance sector, the solvency ratio is more than 150%, it is 204%, and for the non-life insurance sector, the solvency ratio is more than 150%, it is 166%. So these are the 2 data points that you have to focus on. Okay, now this is the idea. Now coming to the next question, try to read the question carefully and try to answer this question. Okay, so here basically the India's household debt at 41.9% of the GDP. This was low compared to other emerging market economies. So India's household debt is at 41.9% of the GDP. Now out of the household debt, maximum of the household debt is going to the non-housing retail segment. Okay, so non-housing retail segment or the non-housing retail loans, they have got the maximum. They have formed 54.9% of the total household debt. So the maximum of the household debt is going to the non-housing retail loans, that is the consumption loans, we can say, for the personal loans, credit cards and such. Now housing loans on the other hand formed 29% of the household debt. Okay, so housing loan, it formed 29% of the household debt. Okay, so here just remember that the total, out of the total household debt, that is 41.9% of the GDP, the maximum has gone to the non-housing retail loans, that is 54.9% of the total household debt has gone to non-housing retail loans, and 29% has gone to housing loan. Now this data point becomes important because this data point was mentioned in the newspapers, and you know that whenever the questions are being framed, they are also taken from the newspapers directly. Okay, so this statement has directly come in the newspapers, that's why this statement becomes important. Even this data point is important, that the aggregate level, at an aggregate level, per capita debt to the individual borrowers has grown from 3.9 lakh in March 2023 to 4.8 lakh in March 2025. So this data point also becomes important. Okay, now these data points were mentioned in the newspaper and that's why they are important. Now coming to the next question, that with the present deposit insurance limit of 5 lakh rupees, dash of the total number of deposit accounts were fully insured. So under the DICGC, that provides the insurance for the deposits that you are doing in the banks. So your deposits that you are doing to the banks are insured up to the limit of 5 lakh rupees. Now with the present deposit insurance limit of 5 lakh rupees, dash of the total number of deposit accounts were fully insured. So what percentage of the total number of deposit accounts were fully insured, and 41.5% of the total value of accessible deposits, they were insured. So 97.7%. Yes, very good. Good to see that you are able to answer the question. So Muskan has given the right answer. Mukund has given the right answer. The right answer here is E. Okay. Guru Raja has given the right answer. So 97.6% of total deposits account are fully insured. Okay. So E is the right answer here. So with the present deposit insurance limit of 5 lakh, 97.6% of the total number of deposit accounts were fully insured. So this is the important data that you have to keep in mind. Now coming to the next question. So over the last 2 decades, the non-bank financial sector has become an important provider of financial intermediation, and the assets of NBFIs, the non-banking financial institutions. Non-banking financial institutions. This refers to the NBFCs, non-banking financial companies. This refers to the insurance companies, the pension funds or the pension agents we can say, or the intermediaries that are in the pension sector. So these are the non-banking financial intermediaries that are the NBFCs, the financial institutions other than the banks and such. Okay, so this is the idea. So now the NBFIs have grown at a more than double the pace of the banking sector, and the share of the non-banking financial institutions or the non-banking financial institutions, their share has increased to what percentage? So it has increased to 49.1%. Okay, very good. So here you can see this is the diagram. Okay, now this is taken from the financial stability report, and this shows that the global non-banking financial institutions, their share is 49.1%. The 49.1% of the total global financial assets is with the non-banking financial institutions. Okay, so 49.1% of the total global financial asset is under the non-banking financial institutions, and for the banks, the share of the bank is 38.1%. The share of the bank is 38.8%. So this is the idea. So this we have discussed in the FSR, that 49.1% of the share of NBFIs has rose to 49.1%. Okay. Now this is the data for the MSME, that the gross non-performing asset ratio of MSME portfolio of scheduled commercial bank fall to 3.6% at the end of March 2025, as well as the MSMEs in this category, the micro enterprises, they formed 49% of the total credit to the MSME sector. Okay, and the subprime loans or the subprime borrowers have reduced from 33.5% in June 2022 to 23.3% in March 2025. So these are important data that you have to keep in mind. Okay, now a question can come that just try to tell me that which risk category has the has the maximum decrease in the risk. Which risk category out of the global risk, out of the financial market risk, out of the macroeconomic risk, and the institutional risk, So out of these four types of risk, which risk has seen the highest dip? The global risk, financial market risk, macroeconomic risk, institutional risk. So which category of risk, which group of risk has seen the highest dip in risk? Highest dip in risk. So it is macroeconomic risk. Okay, so here you can see that the global risk has seen the decline, the macroeconomic risk has also seen the decline, the financial market risk and the institutional risk, here the risk has increased. Sorry, in the global risk, the risk has increased. In the institutional risk, the risk has increased. Only in the macroeconomic risk and the financial risk, the risk has decreased. Now the maximum decrease in the risk has come in the macroeconomic risk, because here you can see that the risk has decreased to 5.2%. So the lowest of the risk is in the macroeconomic risk. Okay, so the risk has decreased to the maximum, the risk has decreased maximum in macroeconomic risk, or the risk has come down the maximum in macroeconomic risk to 5.2%. So this is the idea. Got it? So basically, if the lowest risk is in which risk category? So it is in macroeconomic risk category, that you have to remember. So in the global risk, the risk has increased. In the institutional risk also, the risk has increased. But in the macroeconomic risk and financial market risk, the risk has decreased, and the risk is lowest in macroeconomic risk. Not decrease the maximum, but the lowest risk is in the macroeconomic risk category. So lowest risk in India is in the macroeconomic risk category, and the risk has decreased in both macroeconomic risk category and financial market risk category. Okay, so this is what you have to keep in mind. Now there is a homework question for you. So this is a homework question. Let's see how many of you are able to answer this question. This question is also related to your monetary policy committee, because the same data was given in the monetary policy committee of June, and this data has been discussed a lot of times. So that's why I am giving this data as a homework question. So I hope you will be able to answer this question. Seeing the macroeconomic conditions, seeing the growth of the country, you have to tell that RBI has projected the real GDP to grow at what percentage in 2025-26, same as in 2024-25. Okay, So this is what you have to answer. This is the question for you. Okay. Now, if like these are the most important data that I have marked, but I will request you to go and see the session if you have not seen the session, and go through the data through this detailed coverage, because sometimes the less expected question or less expected data can also come in the examination. But I have shown you that okay, which are the most important data and which data you have to focus on. But I will suggest you that do go through the PDF of this session, do go through the session itself, so that you understand the data, that what is the net interest margin, what is the provision coverage ratio, what is the gross non-performing asset and such. So do go through this session so that you have the clarity about the data, and do go through the data through this detailed coverage. Okay, but I have taken the MCQ session so that you know that what kind of questions can come in the examination. Now, if you want to see the descriptive question from this financial stability report, or if you want to practice the answer writing, so for the answer writing practice, we have the perspective 360 degree. So this perspective 360 degree session, this is taken by Jaskaran sir on Monday, Wednesday and Friday at 5 p.m. Through this session, you can do the answer writing practice for the top hot news that are going on, the current affairs, the current news that are quite in news. So for those topics, what kind of questions, descriptive questions can come. So for that, you have the perspective 360 degree series on Monday, Wednesday and Friday at 5 p.m. You can do the answer writing practice with Jaskaran sir, as well as homework question is also given in the perspective 360 degree series. So you can write the answers in the comment section below, which also gets evaluated free of cost if you answer within 48 hours. This is the idea. Okay. So this is it from my end. Do give me the right answer of the homework question, and do tell me that how much marks you have got out of 10. So there were 10 questions out of 10. How much marks you have got, and do give the right answer of homework question. So this is it for today. Thank you everyone. Thank you everyone. I hope you enjoyed the session, and in case